Good morning, everyone.
We're recording now.
We are recording. Roll call, please.
Mike Berlin,
Here.
Laura Negro,
Here.
Matt Kenny. Here. Ron Steinberg,
Here.
Marty Vitek,
Here.
all present and accounted for, sir.
We have a quorum. I'm looking for approval of the agenda with the additions.
I'd like
Do you
to add
want
two
to take
things
those?
to the agenda, chairperson. I'd like to add an update on the Sanborn tax case. And then add the AADC request. Quarterly payment for request for binding.
This is Pat. I'll make a motion to approve as amended. I'll second it. Marty Vitek.
We have a motion by Pat, second by Marty. All those in favor, signify by saying aye.
Aye.
Opposed, motion carried. Do we have any public comments? Anyone out in the audience? Online? Public comments, anyone? Public comments. Moving on, discussion items. Where did you want to put those third quarterly payments? Is that the end of the agenda or?
Well, since we have Carver on the line here, why don't we have him right after approval of the minutes, because then he can go back to what he's doing. So let's put that as number 4A. AADC request, and then update on Sanborn tax case. We can have that as 7A after the financial reports.
And as a note, the amended agenda should be updated and posted online for the public.
Yeah.
Thank you. Yeah.
Normally what we do, just for the committee's benefit, whenever we amend agenda, we actually add it and we title it amended agenda. And we actually add it to the packet so people can see what was there, and then we highlight in yellow, say what did we add. So that way people can know what did we, at the last minute, what did we do? Are we trying to hide stuff, shenanigans?
Yeah, thank you.
Number 4, approval of the finance meeting.
This is Pat. I'll make a motion to approve.
Ron will second.
Motion by Pat, second by Ron. All those in favor signify by saying aye. Approval of the minutes.
Aye.
Opposed? Motion carried. Thank you. 4A.
4A is the AADC request for quarterly payments and report. Carter.
Oh, good morning. Yeah, I submitted a letter of request earlier in June, requesting $6,250 from the county to come to AADC to help fund our programs for entrepreneurs, business owners, nonprofits, and so on. It was a standard letter that I send out every quarter. As far as a report, I can tell you that I have been getting a lot of phone calls from people that both live in the Ashland County area and live out of the area that are interested in starting businesses primarily in the city of Ashland is where most of my calls are coming from, but not all. Before COVID hit us that November, December beforehand, I was pretty excited because I couldn't keep up with the number of inquiries that I had gotten from entrepreneurs. And I thought 2020 was going to be a fabulous year for us. And then when March 2020 came along, everything just stopped, at least momentarily. But it was just kind of like hitting a pause button because by the time summer of 2020 came, I was starting to get phone calls again. And there was one day about 2 weeks ago that I had 3 entrepreneurs call asking questions about Ashland. I mean, these 3 were viable business owners who either ran a business or had experience running a business. And so they have a really good chance of getting these off the ground. So I'm back to feeling very optimistic. There's a lot of folks that are looking to move to the Ashland area in order to start businesses or to bring their existing business up here. And fortunately, they're smaller businesses, and it's like one employee business or a family-run business, and they're bringing their employees with them. They're not going to need to hire people. So of course, that removes one of the obstacles for them. So I can report and tell you that things are looking good as far as new businesses starting up. And also some businesses that are expanding. And I think we'll continue to see that this summer. I can't give you information on the names of the businesses, but I think that as the summer goes on, you're going to be hearing about them pretty quickly anyway, as they make their announcements about what they're doing. Of course, we continue to have lots and lots of problems with staffing in the community. That's not a surprise to anybody. I'm spending a lot of time with the child care centers because, as you know, if we lose any more child care centers, when we lose a child care center, it affects 8 families, you know, if it's an in-home business. And if they're working parents, then that affects 8 businesses. When we're talking about the Evergrow, we have a capacity of 95 children. So if we have to close a classroom for lack of a teacher, even on a particular day, that can affect 20, 25 parents who can't go to work. And then that affects 25 to 30 businesses. So it has a great multiplication effect when we can't staff childcares. Not to say that it's all the other businesses and nonprofits that are struggling right now to find employees that they hurt any less, but there is somewhat of a multiplication factor when we're talking childcare centers and in-home providers when they have staffing issues. So this is currently a really serious struggle for the Ashland County area, as well as many other places. We're not unique in this whatsoever.
Thank you. Looking for a motion to endorse the third quarter payment of $6,215.
Hey, Marty Vitek, I'll make the motion.
Your motion? Second?
This is Pat, I'll second it.
And Pat seconds. All those in favor signify by saying aye.
Can we have Carver finish his report?
Pardon?
Can we have Carver finish his report? It seemed like he was still talking.
You still talking?
You know, that's just fine. I'm always available for questions. If anybody has any questions, this is probably the most serious issue. And I think I've kind of shared that with you, and you all have an understanding of where we're at. So at any point, anybody wants to contact me for more information about childcare centers or entrepreneurs, feel free to do that. So please go ahead with your motion. That's fine.
Okay, we have a motion and a second. All those in favor say aye.
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 Motion carried.
I will just I will add though that the AADC building has just been a godsend to the Spark program. They're rocking that program down there. They've done, Carver has been very flexible with remodeling and entrances and bathrooms, and this is an excellent program. I just can't be more pleased with what they're doing in that building with the Spark program and this at-risk youth program. So thank you, Carver, for doing that.
Thank you.
Number 5, RFP.
Okay, so you all got copies of the RFP for audit firms. We currently utilize Whittley.
Yes.
And these are the prices. So the question when you're looking at these RFPs, each one of them is anywhere from 25 to 40 pages long. They list their personnel, they list resumes. It's somewhat of a, hard decision to decide who is the best company. On the chart on the board here, you can see you have, Kerber Rose has a not to exceed 50,500. You have Whipley not to exceed 57,100. Clifton Larson Allen not to exceed 60,300, and Baker Tilly 71,200. Our neighbors to our north and our south utilize Baker Tilly. They can't say anything, they praise them, they can't say anything bad about them. So, but they're the highest price. I guess, to a certain extent, you kind of get a little bit what you pay for. You pay more, you're gonna get more services, and you pay less, you're probably gonna get a little less services. At the minimum, everything they have to create the state reporting, they have to do the Form A, there's highway reports that have to be done. There's obviously the end year audit to report and file away with the government. In addition, they do because we are receiving federal money, we have single audit, and so they do a single audit where they dig in depth on individual grants, and this is a federal requirement for any agencies that utilize, more than $700,000 of federal money in the course of a year, which of course we do, and all of them would do that. So I honestly don't have a strong opinion on this. One of my suggestions is because these bids are normally good for about 60 days. So we are in the middle of June. They're good till the middle of August, probably. You're signing a contract basically for the 21 audit. So we are, for 2022 audit, right?
21 audit.
21 audit, yes, okay, yeah. So the audit that we're currently working on is 2020. They've, Whitley has been in, they spent a week with Sue and the staff. They've done some preliminary numbers, they've done some fiscal reporting and fiscal statements. They'll be coming out with their audit report for 2020 in September sometime. And so like I said, part of me wants to say, maybe just stick with what you have for a year and let your next administrator come in. I mean, there are some administrators on this list that have, strong financial background. They've been finance director. One of them even had a CPA. And the question for me, you're looking at a 5-year contract or a 3-year with a 2-year extension. I'm loath to put my thumb on the scale here because I'm leaving in, August or September. And unless somebody has a strong opinion about this, I would maybe just recommend just doing it again next year. The RFPs out there, these guys probably just have to dust them off and put inflationary raises in them. And have, if you get a finance director that's a county administrator who's really strong in finance, that person may have an opinion about this that I would hate to overrule or weigh down on.
I have some knowledge of both. Baker Tilly used to be Virtual Cross, and both them and Whitley, and they're good, competent people. There's no question about that in my mind. The other two I'm just not familiar with. In keeping with what Clark was saying, it'd probably be in our interest just to keep Whitley for another year. That's what I think.
We utilized Clifton Larson for 3 decades at St. Clair County. I mean, we're very happy with them. I think they're a top-notch company. I don't have any problem. Frankly, I think when you look at the references on these firms, they all do work in Wisconsin. They all do counties. They all do municipalities. I don't think there'd be an awful big difference. I think part of it is how much work we can do as staff to prepare for them versus how much they have to do. So
if we switched, would that impact your load at all as far as getting them up to snuff?
Oh, hugely. I mean, I really think that I agree with Clark, depending on who comes in as administrator. They may have a different feel for how they want the financial things to run. And to keep Whipley on one more year, and because we're familiar with them and they know our stuff, we know what they expect. And then be transitioning with a new county administrator as well, I think it would really be a lot for all of us to.
Yeah, and the reason I asked that, in my career, I've had plenty of instances where administrators decided to make changes, they have no idea the impact on those who actually have to do the work. And sometimes it's like, you know, you want to say you have no clue what we do and how much work this is. That's why I asked that
I
question.
appreciate that.
And then we also have the firm doing the financial plan. And right now you have a good working relationship with them and processes and getting them data and stuff. And one of the things that happens is when you get behind on, the more you get behind, the harder it is to do the things that the audit says that you should do because you're too busy
Exactly.
jumping. So I agree with the sentiment, so I'll make a motion to stay with Whitley.
I'll second it.
Got a motion by Pat, and second by Ron. I'm keeping Whitley. All in favor, signify by saying aye.
So we just did this as an exercise in doing a RFP? I thought we had talked about, 28 years with the same firm and,
Well, Laura, my take on that is this. Regardless of our auditor, if we're not following recommendations in there for whatever reason, lack of funding, lack of staff, lack of political will, et cetera, the bigger question is, when are we going to get to a point where we can follow recommendations from the auditor? I don't want to blame the auditor for our situation. They've been pointing some things out for a long time. The issue is we've got to get to a point where we can address what's pointed out in those audits, and some of them are pretty big issues. That's the issue that I think we need to wrestle with. It's kind of like, shooting the messenger at this point. In my view.
I just asked if this was, I don't know why we brought it up then, if we were gonna just not follow through. So, okay.
So one of the things I think will be different, you may ask, okay, what's gonna be different this time next year when you do this? Well, I think one of the things will be different is with our financial consultants. The money that they're going to bill us, first off, this year is being paid by WEDAC or the Department of Revenue. Next year, the ARPA money can be utilized for this. It specifically says financial guidance and helping develop plans and oversight and management of this. I'm gonna put in the budget that we spend $25,000 or $30,000 on them next year. One of their goals is that right now we have our audit firm do not only financial statements, but they also do the year-end adjusting journal entries. They'll be able to help us with that, which is more in tune with what management should do versus auditors should do. And so I'm hoping by this time next year, you'll have a change up of how you do your reporting, how you do your year-end entries, and how you do your financial statements. You'll be in a different situation, in my opinion. Hopefully better.
I just got a question.
That's what I was gonna refer to, was that by having that financial review and process, that's just one more ball in the air while we're trying to do an audit, that just complicates things more. I thought we just should do this, yeah.
You okay, Laura?
I'm good. I just
Yeah.
wanted to clarify.
And Laura, I guess one other thing is, when I was with the city, we dealt with some similar issues, and we don't have a finance director right now. But if you have someone, that we bring on board, and hopefully the not so distant future, then if we have a really good person, they're going to have some views on what they're looking for. As far as audit firms, what services they're looking for, but also other things, software that they use, et cetera, so that they can build around what they think is going to give the county the best chance of being successful and running efficiently. Versus if we change things now, then, it's more work for staff, but we haven't addressed the underlying issues, which to me is really getting to that point of a finance director on staff to provide leadership there.
Okay, I just said I wanted to clarify, so.
I have no other questions. We have a motion and a second. I'll call for the vote. All those in favor of, say aye.
Aye.
Opposed, same sign. Motion carried. Thank you. Any budget discussion?
The highway discussion here, first off, we have two issues. We have what's in the packet. And then Matt actually put together to talk specifically about his budget. And so Matt was on vacation for a couple weeks, so he did not have time to put his material together for a budget review for 2022. And so we just added that material. So I'm gonna go through what I have first, and then we'll go through Matt's PowerPoint presentation when he talks about the actual budget. Because I think it's beneficial for you to understand what's going on here. I'm not gonna read through the information. I'm assuming you've all read through this information. The bottom line is, when you start looking at Matt's plan, and you can see on the spreadsheets that you had, right now you're funding road construction with $520,000 of debt levy, in addition to money coming out of the road fund. This year, we're having to write a check for $975,000 next month for this road construction. If you go to the bottom of the sheet here, and you look at your investment reports. So you're gonna take out $900,000 out of here. The treasurer's account is down to $600,000. And the other investments you have are the CD and the $500,000 in melon. So pretty much we're gonna cash in the CD because the treasurer thinks you need to keep the 500 from melon and the $600,000 in the treasurer account. So we're gonna be able to handle the cash next month. But it's taken some of us calculation from Amber and Matt to figure out when is this bill gonna come in? That's not gonna work next year. You're not gonna have the cash. If you look upon Matt's schedule, where he's got $520,000 for 2022 concerning debt levy for financing road construction. Within that, there would be a 1.1 plus 250, so basically 1.4 million coming out of the road fund to do road construction. And there is no cash to do that. So when Matt's developing his construction plans and Matt's talking to road construction, the highway committee is going over this. They really need to manage at the cash level because we don't have the money. Even though on paper there's money for this thing, it's not there. One of the things that this committee should discuss in order to help Matt figure out what his budget is, would the committee support or recommend to the county board increasing the debt levy to $1 million per year for road construction instead of $520,000. In addition, there's other things within the debt levy, but basically you're looking at around a $500,000 increase specifically for roads. The other thing is the highway committee did vote to forward the wheel tax at $25 car or registration fee to the county board, which you'll be discussing on July 20th. And we'll try to do a better job of explaining that it's not for tire. And a couple other questions that they had will answer within the county board packet for the 20th. That would bring in about $300,000 a year. And we would be looking for, obviously, if this committee would support that also. And then also, or just basically say, Matt's gonna have to limit road construction to the cash available and $520,000 debt levy every year, which means this 2034 plan, I don't know, Matt may not be alive by the time it's done, I mean, we'll all be dead, but Matt and Amber will still be here, but I guess part of this discussion is, what is from a cash management standpoint, what is the committee's appetite to fund roads?
when I look at this, you're asking us to consider one part of the budget in isolation to the entire budget. And so I'm not ready to vote yes or no on any of that because it's in isolation. I would like to look at the entire budget that's proposed and then say, okay, if we have this much carved out for roads, is that enough or not? And if we say we want more for roads, then where are we gonna get that money for roads, or what are we gonna cut or reduce somewhere else? Because we gotta look at everything to vote on a budget. We can't just take parts in isolation and say, if we put this much here, we don't know what that leaves us elsewhere. The wheel tax, it's the most regressive tax there is, especially for the people down county. And they tend to be poorer than the people in the city of Ashland. They have lack of public transportation more so than the people in the city of Ashland. At least people in Ashland can catch the BART bus, and some do instead of having a vehicle. If we have a wheel tax, Walmart doesn't pay, Walgreens doesn't pay, the family that owns the Quick Trip stores don't pay, the business owners that live in Bayfield County don't pay, there's business owners down county that live out of the county. None of them contribute. And that's what makes it so regressive. If you look at your property tax statement, the average house is somewhere towards a 4% increase with that 25% wheel tax. Someone who's got a $400,000 or $500,000 house, you're talking a 1% increase, and yet they have greater capacity to pay. Someone in a $50,000 or $40,000 house, well, now you're talking a bigger increase, and that's the part that makes it so regressive. So my preference on this is I'll never vote for a wheel tax. I'll just never do that. But what I will consider is saying, if we want a certain amount for the highway department and roads, we can put that on a debt levy. We don't need to pass a referendum. So if you're talking $300,000 there, if we look at our debt levy as a whole and say, okay, we want another $300,000 for roads, so we raise the debt levy by that $300,000, then we distribute that tax burden in direct proportion to the assessed values of all the properties in Ashland County. And then going forward, the county board should say, okay, instead of a wheel tax, we bumped up the debt levy by $300,000, and we need to maintain that plus adjusting for inflation. And that way it's equitable to everyone. And if our tax increase is more than the rate of inflation, more than the cost of living, one of the things that we should point out to people in the county, and perhaps loudly and clearly and repeatedly, is that we chose not to have a wheel tax. Instead, we put it on the debt levy, so everyone pays in direct proportion to their assessed value, rather than having a regressive tax. So that's my view on this, and I really personally don't see that changing. But would I support an increased debt levy for roads going forward? I will support an increase, but the amount, I want to see the budget as a whole. And that's true for everything until, that was my experience with the city. We'd look at the budget as a whole. And then you'd say, okay, how much are we willing to raise taxes? How much support is there for what level of taxes? And then we talk about those priorities, and then you do your adjusting from there. But I can't vote yes or no on anything in isolation until I see the budget as a whole.
More comment, Laura?
What Pat said. I agree with that. I don't like taking it all, if we were gonna sit down and go through department by department and work through this, I can. I have actually had people with the wheel tax that were kind of half and half by this time, but I find that's a Band-Aid move, and I find it's a tool you need to keep in your belt until you absolutely need it. And I still don't think we're at the absolutely need it point. I do think we need to explore that piece of where we had the lost revenue and see how that comes out. And I agree with Pat that the roads are important, and we need to, if we're looking at doing the wheel tax for the $300,000, then at this point, if we're going to take this in isolation, and not consider anything else, I would be more open to that. But I, as an overall budget, we have to look at everything, because if we're putting that much into highway, what are we gonna not be able to put money into? And we haven't even got our surveys back, so.
And the other thing that would help me think about stuff is, okay, there's supposed to be, a few million in the road fund, and it's not there. There's supposed to be 1.7 million in the healthcare fund. It's not there. So one of the things that we have conversations about is putting money back into these funds. And I can understand the conversation on the one hand, but on the other hand, we don't have any good ways of addressing those things. And money was spent by the county over a fairly long period of time in various ways that were approved by the board, or at least neglected by the board if they didn't follow recommendations in the audit firm. I would personally find it easier to wrestle with these questions. One, when we have the survey back, but two, of just saying, okay, yep, the healthcare fund is 1.7 million short. That's how it is. Let's start from scratch on that. And the highway department, we don't have money there. And if we keep lamenting about the money that isn't there, and we know we can't put it back in any easy way, one, I don't see a viable option to solve that. And when I say viable, I mean, we're not going to raise taxes and raise that 2.4 million. But what we can talk about is, if we want to invest in our roads, and I use the word invest purposely because I understand that as they deteriorate, it costs you more to do repair work. I grew up on a farm. I worked in engineering, the Navy. I fully appreciate doing your preventive maintenance as avoiding, long-term repair costs. It is the most cost-effective thing in the long run. So I would support saying, okay, how much do we need for the roads going forward? And figuring out what that number is, and then seeing if the board is committed to penciling that into the debt levy, with the understanding that going forward, whatever number we set, we know that that's what we need to do as far as funding the roads, because now we got a plan for funding the roads. We know how much it is a year. We need to bump it up for inflation. And, we know where that money is coming from, and it's direct proportion to the assessed value. To me, that seems simple and straightforward and comprehensible to people, including board members. But trying to stick money back into things where the money isn't there, that gets harder to think about and harder to juggle. And we got into this mess because people were juggling things for a long time. And what we really have to do is say, what money do we have to work with? And how can we raise funds? And the debt levy, we don't need a referendum. So that if the board is committed to a certain level of funding for the roads, well, then you pencil that in each budget season, you say, here's what we need, and here's what we've been doing, and here's how we need to adjust that for inflation. To me, I can think about that, and I know directly what I'm supporting and voting for then.
Marty?
But in using the debt levy, it's specific for a purpose, but what it does is it gives some flexibility to the balance of the levy, and we can, with those dollars, we can begin to correct that mismatch in insurance.
Yeah, and I think when you say correct, I think that's a good word, because, okay, we're 2.4 million short, and we should keep that in mind, because when we look at what we need to put into the roads, we keep it in mind because, okay, that money isn't there, that 2.4 million that's supposed to be there. So yes, we're going to have to put a disproportionate amount into roads for a period of time to make up for the fact that there's money that's no longer there. So we understand why we have to fund more for roads going forward than we did in the past.
Yeah, and part of the discussion is, it's a different mindset. When I talked to, I was talking to Burnett County the other day. I said, just how much money do you have just in investments? Similar size county, they have 11.5 million. Price County has 10.5 million, and the treasurer is very nervous. In fact, one of the things that you may have to consider in coming, because we were concerned we weren't able to make payroll next month. But we have the money now, we think we're gonna be able to do that. But come the last part of December and the first part of January, you may have to take out a line of credit from the bank in order to make payroll. This is a whole different way that manages. You're managed to cash. You're not managing any other way. And one of the thoughts is we basically would look at it because we have the $1.5 million in the ARPA money. Now, you can't just take that money and use it for something, but the question is, if you borrowed it for 30 days, if you had planned to pay it back, that'd probably be acceptable. If you're borrowing it, but you don't have a firm plan how to pay it back, you're just digging yourself further and further in the hole, and you're paying a credit card with a credit card. So, those are a couple of the issues. We're not gonna have to make a decision today, but with your new administrator coming in the fall and with the fiscal people giving us a cash flow analysis, they'll help you determine if you're gonna run out of cash. And Mike, Laura has her hand up.
Yes, Laura?
And the assumptions we have so far are based on the fact that if our healthcare costs don't change. We already know that, I know, just from talking with the consultants I talked to, that our new healthcare consultants should be able to save us some money and streamline that. So we don't even know what that piece is yet. So, I mean, once it comes to putting things back, we've got so many moving pieces, as you said, balls in the air. And if we can't do an auditor at this point, because we don't want to upset an apple cart, I just don't find myself wanting to jump into a wheel tax at this point, unless, like I said, that's a last man standing kind of thing for me. We use that up, we don't have it again.
So, are you ready for your PowerPoint?
What's that?
You got a PowerPoint coming up here?
If you guys are still on the discussion on this.
Yeah, if you guys are want to move on, man is here to talk about his, you're talking about a 21 budget or 22 budget?
So I just brought our 21 budget. Our 22 budget will be somewhat similar.
Maybe sit over there next to Dick, okay, right there, because then the camera will catch you and then you'll be on the microphone.
So the 22 budget would be very similar to the 21 budget I just brought. We haven't worked on the 22 budget yet.
Guys, if you're gonna side talk, I can't hear Matt.
That's pretty much it.
So I put together this presentation. So we started with the 2021 revenue.
Hang on a second. And Laura, I just sent that to you from my phone, so you should have this PowerPoint also, so you can see better than it's on the screen.
Thank you.
So Clark had asked us at our department head meetings a month or so back that some of the bigger departments would present our budgets, where the money comes from, where the money goes. So this is just a overview of that. So the first page is the 2021 revenue. If we go to the next page, I give a brief description of the lines of that revenue. So we have our local transit revenue. In 2021, it was $464,984.83. This is the Ashland County portion of the gas tax. The next line is the local road improvement program. It's $4,100. This is a payment we received from the DOT for administering the LRIP program to the towns in the city of Ashland, city of Mellon.
What's LRIP?
Local road improvement program. It's funding for projects, road projects. Say our GG project, we are getting $231,000 this year in LRIP funds. And it's LRIP is the big name. There's the TRIP TRI program. That's the towns. There's the CEHI is the county, and then there's the MSIP is the city and the village portion. So there's three different pieces of that. The commissioner of every county oversees that, works with them to disperse the money or see. It's a 2-year program. Every 2 years there comes X amount of dollars available in each program, and we have committee meetings between each division of municipality to divide up that money for different projects. So that's just income we get for the administration of that program. The next line is the non-metallic mining revenue, $7,700. This is fees that we collect yearly from all the gravel, basically the gravel pits in the county, to administer it's basically the reclamation plan is all that we administered. It's making sure that there's money available in escrow accounts or bonding to reclaim the pit after the business is done using it. So they have to get a yearly permit, county permit, and then it's also, there's a DNR fee in there. We collect that and then pay it to the DNR for all of the pits. So that pays for that. Next line is the state highway DMA revenues of 5,000. That's discretionary maintenance over and above our regular money we receive from the DOT to just maintenance projects. They keep them under 5,000. We usually get like one of them a year. The state RMA revenue, that's 557,700. That's for the maintenance of the state highways in Ashland County. We have about 120 miles of state highway we maintain for the DOT. Then the next line down is the winter revenue, 430,000. That's for winter maintenance of them same highways for the plowing and what have you. The state LFA revenue. So we had budgeted it in 2021 at 0. That's one problem with our budget process. We have to have the budget done, say, by September to submit to the board, through September, October, November for final. The DOT, after the winter is over, they review their budgets, and if they have any extra dollars, they give them as these LFA projects. We have no idea until the year that we're already budgeted for. So in our budget, we had $0 for 21. We actually have a $105,000 project on State Highway 77 for rut paving through the DOT. So
Is rut paving where you have the divots from tires?
yeah, so semis primarily, you can see that it's kind of a rut, the length of the lane. We come through with we have a machine built that the pavement dumps in there and it lays it out at about 40 inches wide to fill that rut. So it mainly helps with, you get ponding in there, and then the hydroplaning. You're not building all that water up in there, and the vehicles are hydroplaning out of control. So
Okay.
we did about $100,000 work on 77 last year, and we're going to do just over 100,000 again this year. The next line is the state PBM revenue. We had put that in as 50,000 in our 21 budget. There again, that money is not allocated until the year. We received a $100,000 project from them for crack sealing on 77. That would be between 13 and Clam Lake area. These projects, the state started this PBM program probably 4 years ago now. It's actually, we have to submit a bid to do the work. Most of our work for the DOT is time and materials, equipment. It's paid out as at cost. This, we actually have to give a bid, and we can actually make profit on it, and we generally do. We're not going to bid it for to make time and materials, because what if there's an issue so we generally make some profit on that for the county, which has worked out good for us. The next line is township revenues at 200,000. So we plow for the town of Jingles. We do all their plowing. We change the culverts for them. We do some mowing for them. We do work for some of the other townships, doing culvert changes. Sometimes we haul gravel. Sometimes we rebuild small sections of road. So that's revenues coming in from the townships for projects on their end. Next line is county department revenues. We put that at 20,000. We provide services to other departments. This year we have I believe the forestry has $20,000 left on a DNR grant to do some road rebuilding in the town of Jacobs area. Last year we did about $50,000 worth of them through them for a grant that they had received. We also do small projects. We go to the sheriff's department and put sand on their parking lot, or human services, we put some sand on their parking lot, or salt slippery here at the courthouse. So that's where some of that revenue comes from. Private entity revenue, 5,000, that's basically, we sell salt sand to, Bad River Roads Department. Sale of salvage materials, 5,000, this is scrap iron, old culverts, we pull out of the ground, we sell them, we get some revenue from that. And then miscellaneous revenue of 5,000. So that's from permits, plan fees, just revenue that doesn't fit some of our other categories, I guess. So that brings us to a total income of $2,246,480. That's revenue. Does anybody have any questions on any of the revenues we collect?
Do you expect that level of revenue to stay stable?
Yes. One thing I'd like to bring up, so the local transit revenue, last year that increased $51,000. So the state touts it as they're giving more money for transportation, which is great. In reality, for our department, we just decreased our general fund levy by that 51,000. So we didn't get any more money for roads. It just went 51,000 into the general fund. But, you know, they're talking, the governor is still working on his budget, you know, they're fighting back and forth, of course, where it's gonna go, but it's should be the same or more. I would anticipate for our gas tax revenues.
Mike, Laura has her hand up.
Wait for a break here. Okay, go ahead, Laura.
Matt, that state LFA revenue, I know you said you can't count on what exactly it is. In past years, what kind of amounts has that been in, this ballpark?
So last year it was at 100,000. I think the year before it was very low. Was what?
It was like 7,300.
7,300.
Yeah, 0, 0.
So we have we look back a few pages in, we have a kind of a budget history. So yeah, last year was 108, then it was 7,333, then it was 0, 0, 3,700, 0, 129,000 and 0. So it's kind of all over the place. It's just, there's no predicting it. If we have a bad winter, all the funds, the DOT funds that are spent throughout the state on winter maintenance, there's no money. If we have an easy winter, they have extra dollars they're willing to spend.
Just a crapshoot.
Yeah, it is, big time. Yep. Any other questions on revenue?
Clint?
From an accounting perspective, are we now at a point where if money is put into the highway fund, we know that it's going to stay there and not be used for other purposes?
Well, I guess the question is, right now, Matt is balancing the budget. So they're not budgeting to say, we're gonna put in $500,000 into a fund that's gonna stay there. So he's pretty much even. In fact, he's drawing, you know, every year he's drawing money from the highway fund. So there isn't an avenue to put money in, replace that $2 million.
No, I'm not looking at replacing here. Part of what I'm thinking is, you know, obviously in a department like yours, the capital costs are the big part of it, and they're gonna vary from year to year. So from a board perspective, you know, gaining support and keeping things understandable and simple and to explain to the public, if you look at this number of years going out, not a large number, and you look at what is this gonna average, and you say, okay, if we start with X dollars this year, and we know that we need to increase it for inflation by, or costs related to what you do more so than inflation in general, then we can say, okay, we put in X dollars this year, we need an inflation adjusted factor each year going forward. You know, some years you're not going to use all of it. And that's what my question is, then if that money is parked for those years where it's going to be above average, you know, so you're going to have some above average, some below average, but from a board perspective and planning and budgeting, if you start now and have a mean that's adjusted for inflation, and we know the money's going to stay there, because I think part of the reluctance to fund some things is, well, is it actually going to get used for that, or is it going to get pulled into something else? So if we start building that fund back up, so the money is there, so you know that when you plan your projects, that yes, the money's going to be there, that we're not doing what we're doing, then I think it's easier to support this. knowing that once it's approved for the highway department, whether it's used this year or the near future, you know, the money is there.
Yeah.
Because the board was budgeting for this before, except it didn't get used for that. And you know, I want to know that what I approve, you know, goes to where it's going.
Yeah, so that basically just be a policy. Right now, Matt is not at a point where he's underspending his budget.
Nope.
So if he gets to the point where there's so much money coming into his department that he doesn't spend it all, yeah, then it'd just be a general policy to say we're gonna create a separate fund for the road department.
And that's why I'm asking you the question is, are we gonna have a separate fund where there's no ifs, ands, and buts? If there's excess in that fund for what he needs next year, we know that money isn't getting pulled out for anything else by the board or the county.
Yeah, that would just be a decision. We would just set up a separate bank account to do that.
You do have a separate one set up?
We
now?
do not. We do not have a separate bank account. We don't have a passport account for the road department because there isn't any money in it. I mean, there's no money to put into it.
So with the budget this year, if it's approved, I guess now I don't understand why even if there's no money in it, why don't we get that set up so that when it is funded this year, we know that money is segregated and not gonna go somewhere else.
I guess you'd have to look at, so when you look at that 2034 plan, where every year, or most years, Matt's basically taking money from the road fund. It would be years before you'd ever have a dollar that would go in there. Unless you I mean, Matt's gonna have to redo that plan regardless of what happens here.
Sure.
You know, and wherever we end up from the budget standpoint. And I just don't see the point of putting together an account when there's $0 in it and there's no plan for at least for the next 5 years to put money into it.
Because from a budget standpoint, most taxpayers, including people that get utility bills, they like to have a small change each year. You know, something they can live with related to cost of inflation, related to their income. Social Security checks are often cited because so many people are on Social Security in this county. So from a budget perspective, if the board is able to say, yes, we're going to start with this amount and we understand why we need that amount, and it's an average, some years more or less, and then each year you can increase that by the inflation factor, then that makes that part of the budget real steady. And when tax bills are sent out, people get a tax increase that's modest enough that they can live with it. But if we have years where you need more money and now suddenly people's taxes go up a bunch, you know, they don't like that. We've heard over and over again is make it steady, small increases, then people can budget and plan. And so that's why I'm asking about that fund. And that's why I'm saying the mean, you know, think about I'm saying next few years, I'm not going to tell you how many you think about that. And then you take the mean of that and say, okay, the mean of the next few years is X dollars. That's what we need here. And, you know, initially, whatever X is, it's going to have to be as much or more than what you need next year. Otherwise you're short, obviously. So that first X is going to have to be a little more than you spend, but then you start working to build up that fund gradually. And it gives you that cushion. So if you need more one year, you have it. Will help the board having to say, gee, we need to bump up taxes a fair bit this year because we need more for highway. So that it's a much steadier.
We somewhat have that now. I mean, but it's just all included in the general fund. It's not a separate fund. Our
Yeah.
checkbook says we have X amount of dollars. The fund at the county says there's no money. in
And
that
that's
fund.
why I would prefer to see that separate fund and
Yeah.
we basically are gonna start building it up, you know, going forward in the coming year where X has to be more than what you spend. And then that difference stays in that fund and we know it's not gonna go somewhere else.
Yeah, so one of the issues is when you're talking about an overall fiscal policy for the county, there are many different funds. And these, I mean, how many funds do we have, Sue?
Probably 20 active.
So Sue says there's maybe about 20 active funds. So the question is, if all of a sudden you create 20 separate passbooks, your general fund, the one that you pay your bills with, your vouchers, your payroll, all the other things that happen, you just have less money and less money and less money. It becomes very challenging to do that. In normal county government, you don't want to separate and have 20 separate passbooks because then how do you manage your cash? The problem is when you get to a position that we're in, where we're talking about actually not having enough money to pay our bills. You know, what are you going to do? Are you gonna borrow from these other places? And part of it is just overall fiscal management. I don't have any big problem with separate, putting a fund together. It's more on a map to say, man, at what point with the current funding you get from the county, are you going to actually have extra money from road construction, from debt levy to leave in there? You know, that's a, I mean.
Which you can't do with debt levy you have to spend every year.
Yeah.
So that's where we're at with that. If we borrow 520 in debt levy, we have to do 520 in projects. We can't carry that over. That's my understanding. You know, we
Yeah.
run into that problem
Yeah.
before with
Yeah.
Department of Revenue. We weren't spending that money.
Yeah,
We were
so-
saving it, so.
So answering this question, I'm a bit confused. We had 2 construction projects this year and they both came in under budget.
Yes,
So is that a savings or is that something that we're pushing on to next year? Because correct me if I'm wrong. We used $65,000 of that for engineering of 3
Yes.
projects so we can put them on a shelf. Hoping that we can get funding for that. It's going to be competitive that we have to have those projects on the shelf.
correct.
So then in fact, some of that savings that you had on those 2 projects that came in under budget, we're utilizing that. We would have to spend it even somewhere down the road, but we're spending it now in hopes that in lieu of competitive bidding, we can get 1, 2, or maybe all 3 of those projects funded by an outside resource.
Sure. Yes. So yeah, we did have projects come in under budget. That money would come out of savings on our improvement plan fund, which the money's essentially not there, but
Yeah, so if you
it's
look-
less money that
and you
the county
probably-
has to pay out of
Yeah,
pocket for
you
these
probably can't
projects.
see this here, but on this chart that's on here, there's basically, for this year, we have one project, the GG fund, there's 489,000, that's supposed to come from the road improvement fund, and then the county road end, there's 21,000, that's supposed to come from the road improvement fund. So if you're under budget, that just means less money comes out of that fund. But being that there isn't any money, it's just less money that gets transferred from the general fund into the road department. There's not like you're taking less money, it's not like you're leaving anything on the table, it's all in the general fund. So there's no savings to say we're gonna take $8,000 from the general fund and put it into here because it's just, there isn't a fund.
I got to back up a second. Marty had a question before I jumped in.
Oh, I was just gonna say that what Pat was talking about was a little more abstract than what I was thinking, and we do have a process to change the budget. The department can do a certain level, the committee can do a certain level, and like that, so that part is pretty straightforward.
I'm really still trying to comprehend how the city or the county got in the pickle they did. And my sense is part of this is if you throw the money all in one pot, and pay the bills, it allows you to spend down what you have more so than if you segregated it. And when you started saying, gee, this fund doesn't have money, then you face the music and saying, okay, now what do we need to change? Because as long as there was $1 there, you could keep doing that. And we end up where we're at. And it's so allowed the board, the administration, whatever, the public too, to, kick this can down the road before having to address some stuff. So going back to the audit, lots of things have been in there, but we're not doing as much as we should. We need a finance director. That's, been clearly pointed out. We need to do that, but it'll cost money. And I think there's accounting practices where the county needs to invest in making changes and updating things. And it may well mean that you need more staff, which wouldn't surprise me to do all the things that would be helpful with this, but I think they're good things to invest in. But as we think about all these things, you need money, I understand that. And the question I think for all of us is where does that come from? And it strikes me that we hear from the highway department almost frequently I wanted to look at the sheriff's department and see if there's things that we can do differently there, structurally different, and free up some money that we can then use for some other things. So I appreciate you need money, but we also need to figure out where it's coming from. The sheriff's department's the biggest part, and I'd sure love to have some conversations
Yeah,
with them.
I mean, I think your biggest cash drain, and this will be the item number 7A when we talk about the Sanborn case. So we have sent out $1.6 million of unbudgeted money that just went from the general fund to the settlements. I'll say that again, $1.6 million just went out the door from the general fund, unbudgeted, that drained the Collins coffers. That's a problem, and it's gonna continue for years, and I basically have a packet to talk to you about this. And then the second thing, of course, is over the last number of years, you've had a drain on the healthcare. You know, because it hasn't been managed, and as you know, as Laura eloquently said, we're gonna have a handle on that. We're confident that we're going to stop the bleeding on the healthcare. In talking with our fiscal advisors, review, they don't really feel there's a path for us to basically put back the 1.7 million from the healthcare fund. They don't know if that would ever happen. But regardless, $3 million went out the door. And where did that money come from? Came from the highway department for the most part. You know, but how you by state law, you have to make those settlement payments. You can't not do that. 1.6 million went out the door, and you just can't say you're not going to do it. But I have a, you know, maybe we should get back to the, you know, if there's no more questions on revenue, go back to expenses.
With expenses. So that's the expense page. We'll go through just like the revenues. So administration, it's 30,200. This is office supply, committee expense, postage, commissioner travel and training, advertising, computers. Patrol soup expense, 17,695. That's training, cell phone, his vehicle, travel. And this expense is reimbursed at 60% from the DOT. They pay for 60% of his wage and all of his expenses. Radio expense, $5,703. This is our two-way radio system we have to talk between the trucks and vehicles and the office. Our general liability insurance is $17,000 a year. Labor incidental, so this $1,372,500, that's all of our department labor and our fringe benefit expense for all the employees in the department. Field small tool expense, $18,000. This is purchases of tools under $5,000 a piece, you know, drills, hand tools, signage, what we need to do our work. Shop operation expense, $38,019. That's shop tools, shop supplies, shop equipment. Fuel handling expense, $250. That's for our fuel pump maintenance. Machinery operations expense, $350,000. That's our parts, fuel, lube, tires, all the equipment maintenance that goes into our fleet. Depreciation also, yes. Thank you, Amber. Gravel pit operation, that's at zero. We don't have any expenses in 21 for gravel pits. Building and grounds, 100,000. That's all of our maintenance, our utilities, cleaning of the buildings. County highway expenses, 100,000. This is material costs for county highway maintenance, our training, drug testing. County highway winter expense, 60,000. That's material. That's basically salt sand for when we're snow plowing on county highways. State highway winter expenses, 75,000. That's a material cost. That's not including the salt. The state buys the salt on their own dime. We don't, that doesn't go through our books at all. This is, a lot of it is liquids, the brines we use on state highways. State highway maintenance expense, 82,189. That's material costs for our state highway maintenance, patch material, culverts, whatever type of work we're doing on the state highways. State highway road and bridge construction, 40,000. This is material cost for the state highway bridge maintenance that we do. State highway PBM project expenses, 15,000. That's material cost for the PBM projects that we do on the state highways. Township expenses, 60,000. That's material cost for town projects that we work on. County department expenses, 10,000. That's another material cost for when we work on the county department projects. And then the private entity expense of 5,000. That's material cost. So that brings us to our total expenses of was $236,000 or $396,556. So there was our expenses were higher than our revenue for 21, so we were using 150,000 basically out of carryover out of our last year's funds that were still in our checkbook from the year before. Any questions on expenses?
So the work you do for the townships, my understanding is that there's a state rate that you charge them for everything that you do.
Correct.
And so does doing work for the townships perhaps add efficiency to what you do because they're paying part of the overhead? So like the amortization on the building, is that rate cover the cost of the use of the building? Things like that.
About the building, so it pays the guys' wages, basically, so when we're working on a town project, their wages are fully covered, their wages and overhead.
So you say overhead, the use of equipment is.
Well, that, I'm talking incidentals, I mean, all their total wage, their health insurance, their total cost is being covered by the township while they're working for them. And then the equipment is billed at the state rate, like you just mentioned. That's say for a dump truck, it's a state rate, we get that, we charge them that.
Is that rate sufficient to cover, the cost of that?
It generally is.
The insurance, the upkeep, the maintenance, the storage of it?
Yeah, so our equipment, we track it all at the end of the year. It fluctuates kind of up and down from year to year. Sometimes we're 50,000 ahead totally across the board on our equipment. Sometimes we're a little bit behind. And that includes depreciation in that number too. So I think it's sufficient. It's some pieces, the state rates sometimes they don't make sense. Sometimes they do make sense. We do good on this piece of equipment and then this one we kind of lose money. But overall it averages out.
So the insurance, is that independent of the number of vehicles you insure each vehicle?
Every vehicle is insured.
But is your total insurance cost related to the number of vehicles? Do you have insurance on each vehicle separately, or is it insurance for the fleet as a whole?
I would, as a fleet as a whole.
If you have like each piece of equipment, but like we get charged on them all.
You're going to come up to the microphone so Laura can hear you.
Yeah, we give them a list of all of our equipment, so they have a full list of it, and then I update it and get new or take away, I send it to them every time. But it's basically some things are lumped together as like marine general, but under the bigger stuff, they will individually know in the marine, that's correct.
And you have to register each vehicle too?
Yes,
There's a fee for that?
yep,
Very
that usually
minimal.
goes, that usually goes in the cost of like the truck, with like the acquisition of it, I put it all in there.
So the reason I ask that is, if you have some fixed costs related to each vehicle and you keep a number of the older vehicles, if you looked at that plan for how many vehicles you have, and if you could find a way of reducing the vehicles, say by one, you'd have, wearing them out before you buy another one, if that, would work. Then there's some fixed costs like, the insurance and the registration and perhaps the upkeep of those. If you've got some sitting outside, they weather more. And obviously they all get exposed to salt. And so whether you use them or not, vehicles that sit that have been in salt, they don't last as long. And so, you'd have to do some number crunching and thinking about stuff. But if you could develop a plan to have one less vehicle in service and still do everything you need, would that reduce your overhead some? And that would take some digging into. Sure. But I know from my farm experience, you know, it's easy to keep old stuff because you might use it someday, and after a while,
Yeah,
you know, it's either it doesn't get used or you start realizing, you know, there's costs associated with it. Sometimes it's simpler to have, you know, less, you know,
Sure.
plan on how to utilize that.
So Matt, I have a question about depreciation. So right now we take out $350,000 of debt levy for equipment.
Mhm.
A lot of that equipment, you're getting reimbursed from the state at the state rate for basic utilization of that equipment. What happens to that money?
I mean, trying to think how to answer that. Maybe Amber can help you on that.
I'll come in. So this is why it's a little bit hard, like, I don't want to get too in-depth and confuse you guys too much either, but like, the way our budget is set up now, but then if you look at our budget history, I don't know if you want to show that, it's pretty small to me, I know I should have made it bigger, but this is more of like our actual, so that way, like, the cost of the machinery is put into the state, county, town, anywhere that we did work. We charge that to the state, let's just use them as an example. Then it gets credited to our machinery account. So that gets put in almost as revenue. So at the end of the year, what we want is that balance to be zero. So all of our expenses, which would be the insurance, depreciation, any maintenance done to those vehicles, we want that to be equal to what we charged out to the state, county, even ourselves, and townships. So when we look at this line, this 5324 machinery operations expense, technically, when I estimate for this, you know, I have that zero because that's where we want it to be at the end of the year. Last year, we had one very large expense for repairing a vehicle or a piece of equipment. I think it was like, what, 22,000 or something?
3 or
So
4.
that wasn't planned for, but we ended up overspending 64,000. Also, the state had lowered the rates each quarter because fuel went down. So then we had a lot less fuel costs, but we also didn't get to charge as much for our equipment. Now, since then, it's gone up once, I think January 1, some of the rates went back up. And I'm anticipating after this next quarter, they'll go up again, and then we'll change that. But then when we look at 2019, we actually over-recovered 22,000. So it fluctuates every year. The year before that, we were over-recovered 1,700. So that year, we pretty much expensed exactly what we got back. So that's what ideally you want. But you can never predict how it's gonna be. So that's kind of how,
All right,
you don't
here-
know until the end of the year.
All right, here's my basic question.
Mhm.
I mean, going back to Pat's point, which is if you had a bank account,
Mhm.
you know, I mean, we're billing the townships, we're billing the state for utilization of these vehicles, of these trucks and this equipment. If you took that money and put it in a separate account, eventually, we wouldn't have to take on debt levy of $350,000 every year because it would be a self-sustaining account, or is my head just too simple? I mean, I know we're not there yet, so we don't have the money, but I mean, let's say you took all that money and you took the depreciation, you physically put it into a bank account. Eventually, you're gonna have your own funds to replace the equipment based on the rates that you're getting. Or is that too simple?
Well, it's not as, I mean, that would be nice and simple, but I think, you know, not really knowing, I think the number that you'd be looking for to put in that bank account would be if you over recovered that year. So let's say we over recovered that year 50,000, then ideally, you know, next year you have $50,000 to put towards that. I think, maybe before we get too far into this too, we had that conversation with the consultants, and we talked about doing, setting back up that separate fund so that it'd be self, I'm not thinking, I think the word I was required. Yes, so that way we can, if we over under, we can stay in everything in that account. So there's gonna be a little bit of changes that they are gonna suggest to us. And that might change how we think about that equipment purchasing, because they talked about that as well. So that it sounded like their suggestions would be changing some of that, how we do some of that stuff a little bit.
Yeah.
Because he was talking about taking that out. somewhere and then putting it in.
Yeah, when I've talked to my other fellow county administrators, they're very, I was talking about my budget challenges. And I say, we're giving the highway department $350,000 every year for equipment.
Mhm.
And they're like, well, they should have the funds from billing other entities to build into that fund in order to buy it, so that when that truck wears out, of course, bad things happen. Sometimes something gets totaled ahead of time, you can't budget for it within that fund, but that's, they're, they've got, now granted, they have $10 million in the bank, so they can do that kind of thing.
See, and that's something that never used to get treated separately either, we used to get like one lump sum, and then once we started pulling things out like that 520 for improvement fund, all of a sudden that got pulled out in the debt levy, and then the next thing they took out was our equipment, and that got put in the debt levy. So that's why now it's getting looked at differently, but my first few years here, that wasn't looked at separately. So I think, they were looking at things that they could put on the debt levy, each year. So
Yes.
now it's just changed our way of thinking, and that's probably why we look at it a little bit different than that county, but it'd be nice maybe to go back into that way, if we can, I mean, but I felt very positive talking with the consultants, and I understood what they're trying to do, so we're gonna discuss a little bit more. So there will be some changes coming to that, but, what we expend, like what we're going over today is gonna kind of stay the same. How much goes in and out.
So let me piggyback on that. If we're funding something, say, plow truck with debt levy, and you're recovering part of that from the state and the townships, is it permissible to take what you recover and set it into this separate fund and keep it after that year? And not treat that as, quote, debt levy money, because you're sort of washing that money, if you will. If that's permissible, which it sounds like from conversations that you had with other county administrators, one way of building that fund back up is, I think, to do what you're suggesting, if that's permissible with debt levy dollars. We collect from the state and local townships. If you have a rough number for an average in a year, and say, okay, this is planning process, this is budgeting, and saying we're gonna set that money aside. And so that you can build up the road fund, but that means that that X that you asked for as an average for the next few years needs to be a bigger number, because if you do this, you're now planning to set aside what you take in from the others. The challenge that the county has with the budget, among lots of them, is we can raise debt levy as much as we want without a referendum, but we can't raise the general levy. So what you're suggesting there frees up, if you will, general levy dollars from being needed by the highway department more so than otherwise. And if it frees up general levy dollars more so than otherwise, that helps with everything else where you need general levy. So if that's permissible with debt levy dollars that were used to fund the truck, and now you collect and you set it aside, if that's really permissible, I think that is worth
It's
a
basically,
good look.
basically what has been happening. The equipment fund used to be in the general levy, it was taken out, but then revenues from that equipment stay in there to pay for maintenance issues on the roads or whatever. So our general levy has been decreased, the debt levy increased. And so it's basically washing that money.
Yeah,
Already.
I would just want to make sure that it's verified that that's permissible, so we don't find out later it isn't, but that would be, as far as this whole issue with debt levy and general levy, that would be, I think, a very constructive way of helping to address it.
Yeah, and these other counties basically say, once you get to a regular cash balance in there, the money he's billing for other things is enough to replace these vehicles. The problem is we have to put a bunch of money in there, or we have to slowly build that up over the years to get that point. So we don't have, that's not a short-term issue, but that could be a long-term issue for you going, with the next 3 to 5 years.
Yeah, until you can raise the general levy to have money available, doing that, to me, it looks like something you should dig deeper into.
Any other questions on expenses?
I have a question regarding reimbursement rates. You know, when you got a guy out there, let's say on Highway 13 blowing snow in the winter time, you're charging $20 an hour. Starting to say $20 an hour. A portion of that is for health insurance, probably $2, say. Obviously, over the years, that hasn't been enough. You know, we haven't charged our actual cost for that. Is there any
We do
chance?
charge our actual cost. We charge a approximately $40 an hour. I don't know his exact. number
Yeah, every
today,
year,
but-
every year I calculate what our fringe benefit rate is, so I take all of our costs that we put into it, so it'd be even like workman's comp, and then sick, vacation, all of that, and it gets all put into this report, one of the reports I do for the state, and then I come up with a rate, and that changes based on how much labor we did too, and it comes up, so like last year, I think it was, off the top of my head, like 80%. And then if we have a lot of overtime, it'll go down. If we don't have a lot, it'll go up. So, but generally, if we go up average years, we're gonna be 80 to 85%. So if we take and charge $20 an hour for that, then we're gonna charge that 80% to cover that. And that's the same thing as how we look at like our machinery, is at the end of that year, I actually want my incidental labor to be at $0. And like last year, we spent basically $9,000 over, which is a good year. So that means I recovered everything but $9,000 to cover all of our labor and fringe benefits. And the year before that was a little bit more. So what they do is then I'll adjust the rate that's always fluctuating. So the next year, my rate might go up a little bit higher because it's gonna use, previous years on average as well. And then your goal is to recover that into the next year. So so we do get enough to cover our fringe benefit.
I guess I would probably, what I'm saying, talking about would probably apply to human services as well, because they have I don't think it's the same arrangement. But it's pretty clear to me anyway, that we're not being reimbursed the total cost of health insurance overall. I don't know about,
Oh, I see what you're saying, for
Yeah.
health insurance.
My understanding is that the rate that you recover for health insurance is tied to the rate that we're charging employees. And because we've been undercharging, we've been lacking on reimbursement when we do outside work. So as we deal with healthcare, part of what will happen, my understanding is that we're gonna get higher reimbursement rates for the work that we do, like the highway department, and
Yes.
et cetera.
So,
Yeah, that's it, if we change the rates.
Yeah.
M3 is kind of looking at what we're doing. They're thinking our $24,000 per year, per family plan is probably mid-range. So they're thinking we're probably not gonna have to dump a lot more money into it. They're thinking we can probably work with what we have and change the benefit package, change how we manage RX, change all these things, which is what I would hope. So you're right, if on health and human services, some of those departments, the one right below us here, they get 66 cents for every dollar they spend. Now, if we're undercharging for healthcare, which we have been, we left money on the table. Over the last 15 years, you probably left a few $100,000 on the table by not appropriately budgeting ahead of time to say, what are you gonna go into the healthcare? But I can't do anything about that. We're basically going forward, and I'm thinking we're gonna basically just balance the fund the way it is with the money we're putting into it. But, that's what we're paying people to look at. Maybe they will, maybe they won't. But people smarter than I are gonna figure that out.
I guess that was my point, was to make the reimbursement to action.
yes. Any other questions on expenses?
I got something I want to say. I guess I was misled or whatever, about how I get reimbursed from the state for snow plowing and stuff. And I was always under the impression if you have a year like we had last year, where there wasn't an awful lot of snow plowing being done, it would be money ahead, but that's not true, because you only charge the state when you do something. for the
Yes.
state.
Yeah, in all actuality, a hard winter, we make more money from the state. I mean, because we charge more, we charge for our labor and our equipment. So, yeah, the more we work, the more income we bring in to pay for our equipment, basically, you could say. If we don't have any snow, the county purchased a $200,000 snowplow and didn't use it, that's not good.
Yeah.
So the more snow we get, the more we can pay for our equipment, but
It's kind of a catch-22.
it is a little bit, yes, yep. there's no more questions on that, so we put in this presentation, just a budget history from, so it has the actuals from 2013 through 2020. So you can see, it's pretty small, hard to read, but it just, some years, you know, we had, we made income basically, and some years we lost. So generally, I can just run through them. In 2013, we had income of 121,000, 14 was 126,000, 15 was 106, 16, that was the flood year, we had income of 555,000. We did a lot of extra work from the floods. 17, we had income of 135,000. 18, we lost income of 22,000. 19 was a loss of 209,000. I think that was, we built that new building. There was extra costs over what was in the capital improvements for that. 2020, we had income of $9,000. So yeah, that's where we're at for basically profit and loss above our budgeted amounts. Any questions on that?
I think we should get Amber a job in the pharmacy. You can write that small, that's pretty good.
I'm sorry. It was a lot bigger on the computer screen. I didn't look at it when it printed.
Next page is improvement dollars. So our 2021 improvement projects budget. So as you know, we received the 520 in debt levy dollars for improvements. It just has we're gonna get funding, LRIP funding for GG project. We're gonna get a flat grant for GG project. And then it has the project costs. County N is a CBDG grant money. So our projection at the end of 2021 would be our improvement budget going from starting the year at 1.5 million, ending it at 1.3. And as we've been talking about, this is a number that our books show we have it. It's not in the general fund. So any questions on that? The next page is our 2021 equipment purchase budget, and this is also debt levy dollars. The budgeted amount for this year was $294,708. We had originally asked for 405, but when the debt levy got capped, some of that got lowered to the 294. So we're purchasing a new plow truck, patching trailer, and a new pickup truck. We had a track skid steer in that original budget, but that had to get removed from the equipment budget. So that's basically the highway department budget, expenses, revenues. Just to give you guys an overview of where we get our money and where the money goes. Any questions?
So one of the things that occurs to me is, some years we get lots of snow, some we don't, and I know it sort of averages out. But the wear and tear on that equipment certainly varies in the life of it, tied to the weather we get. And the same is true to some extent with some other equipment the county uses. And it's, on the one hand, it's nice to have a schedule and say, here's what we need and here's what we're going to replace, because it makes everything easy to think about. But on the other hand, I'd like to see the county get to a point with capital equipment where there's a process where it's replaced really when that's the most cost-effective thing to do. If we had 4 or 5 winters with hardly any snow, your need for capital equipment is certainly different than if you have years with lots of snow. But right now, we don't, from a budget standpoint, we haven't been doing that. But it also means then that we have to trust departments, and the departments, we're going to have to hopefully trust the board and administration, that when you get to the point where you say, look, it's gonna cost us more to keep this equipment than replace it. We need to replace it, but the money's gonna be there. So part of what I sense with the county is everybody's a little nervous about giving up anything, because if they give up something, they're not sure somebody else is gonna give it up something and that they can live without, and then you're gonna be asked to give up more. It's very natural to go through that. But, you know, to the extent that you can, from a budget standpoint, know that you fully utilize that equipment, it's fully depreciated, and repairs are more than the cost of
Sure.
replacing it, that when you need that equipment, you're gonna get it. But the money needs to be there too. So, you know, it's kind of back to processes where we have to work together to get in a better spot than we're at.
Yeah,
And
it's-
maybe what Matt can do is share with the group, the schedule of turn of new trucks. Every year you buy one new truck, you take a truck off. And what's your schedule, like 10 or 12 years?
So we have basically 10 plow routes. So we buy one new plow truck a year. So that plow truck is in daily plowing duty for 10 years. After that point, it goes into a spare fleet. We have about 4 spare trucks for when we have a breakdown. So it'll sit for 4 years in that spare fleet. So after about 14 years, then we either sell that truck, or some of them we repurpose. We have a truck that does liquids. We have some old dump trucks that we use to haul riprap. You know, and some of these trucks are, I don't know, some 55. I mean, they're
pretty old.
they're 20 years old. So we keep them, some of them, until they're nothing more than a pile of rust, and it's costing too much to maintain them, and we get rid of them at that point. Some of them, you know, if we will trade them in, they have a higher trade-in value at that point. We actually dumped a bunch of newer trucks, if you want to call them that. They went through, we had some international trucks, they went through the 10 years, and they were very high maintenance costs. So we got rid of them and kept older trucks actually for our spare fleet, some older trucks, because they just didn't have a lot of this new electronic stuff, and we weren't having issues with them. They've been very maintenance free, so we keep them. But we were able to get a higher trade-in value for them, some of them vehicles, that selling them a little bit newer too. But yeah, if I don't know how many years ago, it was before me, they skipped a couple years of buying a new truck every year. And it really increased our maintenance cost very high. If we could buy a truck a year, keep it in the hard service for 10 years, and then either repurpose it or put it into the spare fleet, that has been working well, and we feel that's the best bang on for our buck for maintenance dollars and keeping these trucks going, I guess.
Do you also use short-term leases for equipment that you don't use that often?
We do at times. Right now, we're renting a tractor for mowing. We don't have a good mower tractor. So we rent it just for a month. I don't know, it's like $5,000 for a month to rent a tractor from Lulich, go around and mow, mainly the state highways, but use some on the county highways. We also rent, usually every year for 2 months, sometimes 3, depending on how it goes in the winter. We like to start in October, November, and then if it's good weather in December, we'll rent a track skid steer with a brush mower and brush on the state highways. You know, you probably noticed on 13, a lot of the work we've been doing.
I like that.
This works a lot better for us long-term. That's very hard on the equipment to do that. It really beats it up. Our state reimbursement rate, we found out through past years, we're losing money. The county is subsidizing the state for that. So we rent it. The state pays, when we rent a piece of equipment, they pay for the full rental cost and any fuel, any mechanical issues that we have to fix or things that break, they pay for it all. Or if we own that piece of equipment and we go backwards, we lose money. So it's better off to rent, or at least, like you say, a piece of equipment in that case, or it's rough service.
Mike, Laura has a question. Now she's gone from right hand to left hand, back to right hand. And I don't see any weights in those hands either. I think that might be.
Oh, come on, there's lots of patience in those weights. Bringing up that leasing, we had talked about leasing vehicles for our county. Now, say with your supervisor truck, if we would lease with that instead of buy, would that be would we get better reimbursement for those kind of things? Or is it because you guys get reimbursed the certain way it doesn't work out as well? Because we talked about having, all of those like leasing vehicles as a motor pool kind of thing.
I guess I've never researched it real heavy to lease like a pickup like that. The thing is with a vehicle, we buy them at a government discount rate. We get them probably $5,000 cheaper than you can buy them on the open market. We run them generally for a couple of years on the supervisor, then it goes down to the shop superintendent or the foreman, and we trade them in at 4 years. At that point, we're getting like $20,000 trade-in. So a new pickup is costing us $12,000 to $15,000 depending on the new purchase price for 4 years of use. And I don't think we can get a lease rate to match that. If we keep turning them pickups, at 60 to 80,000 miles, we get a very good trade-in rate. And I think, and you add that in with the low purchase price, it's a win-win for the county, I believe, over a lease. I would have to look at a lease, but I think it is.
Okay.
So do we have an action item here, Clark, on this agenda item?
Yeah, there isn't any.
Just a
this is
possible
This is just a discussion to learn, and I'm gonna do this with Health and Human Services. I see Terry Barnham's on this line. So the next meeting we have, we'll have her come in and kind of talk about the same thing. It's been very educational, I think, to have Matt. And this is recorded, other people can go back, other board members can review and say, what do you guys do? Because, in the past, the budgets have been very minimal detail.
Sure.
And I think this is very educational. I look forward to helping Human Services doing the same thing.
Could you rent a plow truck that the state reimburses you for?
Washburn County did lease plow trucks. From what my understanding, it was not a very financial advantageous in the end. It did not work out for them. They tried it. They just have got rid of them in the last year or two, and it didn't work. They sold it as they thought it was going to work great in their initial numbers, but in all reality, how it worked out, it was not good. I haven't looked at it personally, but that's my experience with talking to another county.
And one of the things that we have done, I think it was 1 or 2 vehicles, I can't remember, for Health and Human Services, did you buy 1 or 2? One. So one of the things that we're utilizing debt levy for is trying to develop a small little fleet. Now, right now that goes through the highway department, just from an administrative standpoint, even though the vehicles sit over here on Sanborn. I think you have another vehicle over there too.
We have one that was in our fleet that we weren't using, that we repurposed to them.
Yes, and so in my mind, I would like to see the county develop their own internal fleet purchasing these vehicles. Because you can use debt levy to do that, and then you're basically not paying employees to use your personal vehicles. And it's not, for me, it's not so much the cost that we're spending on mileage. For me, it's more from a risk management standpoint. If we have, especially Health and Human Services people transporting children in their private vehicles, and there's an accident, that employee is gonna have some significant issues arguing between work costs or private costs and all those things. So my goal is to purchase 1 or 2 vehicles a year for the Health and Human Services Department and then manage it administratively, financially through the Highway Department. The Highway Department basically pays all the gas, pays all the maintenance, pays all this stuff, and then they bill the department so many cents per mile. And eventually that will be, I could see, 10 years from now, that'll be a self-sustaining fund because the Highway Department will eventually make money on this. And they're gonna keep that and then buy new cars with it 10 years from now.
Sure.
But that's my long range plan, and I don't know, your next administrator will have to figure it out.
I think as far as that, lease arrangement goes, probably the biggest factor is that initial 4 or 5 years depreciation. An actual market value of that truck from 0 years to, if somebody's gotta eat that, then it's something like Washington County did.
Yeah, I'm not sure the full details. I just know it did not work out as anticipated for them on that day.
Thank you.
Thank you.
Thank you, Matt. Thank you, Amber.
Are we up for the financial report?
So this is the finance report, and we weren't able to put this in the packet last week, but we did add it to the packet yesterday, and it is online on our website in the regular packet information for the public to see. And so if there's any questions on that, Sue is here to answer any questions. Okay, all right. You have any comments, Sue, you want to make?
No.
You have to come up to the
I
table
don't,
to
yeah,
do that.
No, I just want to mention that I spoke with Steve when he was on site with Steve Cabelli from the financial people that are coming in. And Springbrook is developing some new reports, Tableau they're called, Tableau or something. And so Steve and I will be working on trying to put something more with graphs and different things once it's up, and it's just in the works in Springbrook, and so that's coming in the future. So I mentioned that in the email that I sent out yesterday. So bear with us a little longer, and hopefully we'll be able to produce something for you that you like better or like.
I hate to ask, but when we look at these numbers, I hate to ask this, but is the money really there when we look at these numbers?
Yeah, it is. Yes, the revenues that are stated are really there.
We can go on to 7A there if you want.
Okay, well, update on Sandburg.
Yeah, so and if you guys are really familiar with this, just stop me, but I get the feeling sometimes this needs a little bit of review. So this is a case that came out of the United States Federal Court, Western District, Wisconsin on April 9th. And this basically is tribal governments in this part of the ceded territories of Wisconsin versus these townships. And there's some individuals here that were appraisers. So if you look down here, there's individual appraisers. And so in this case, this whole issue started, and I just broke this up a little bit. And I'll probably do a formal presentation with the county board at some point, but this case involves around 800 properties, the vast majority of which are owned by the Bad River Nation. There are a few individual property owners, but most of it is owned by a tribal government. The split is 95% to 5%. These properties have not paid property taxes since 2016, and the county has to make the settlements to the other taxing districts. In the normal course of events, the county would take properties on tax deeds and sell them like we do for any other property that does not make taxes. And so you might remember this past month, we made $168,000 actually on selling properties. Great cash revenue for the county. In this case, the tribal government is contesting the chain of taxation practice. In the past, if a piece of property was owned by a tribal member on tribal land, it's not taxed. If it was sold to a non-tribal member, it was taxed. The properties in questions are one which were owned by non-tribal members, then were sold back to either tribal members or the tribal government and should remain taxed. This is what the court case is about, tax status of properties which go from being taxed to tribal ownership. So in this case, land on the reservation, owned by tribal government or a tribal member, not taxed. It is sold to somebody, it becomes taxed. It has gone back to the tribal government, in the opinion of this federal court case, it should remain its tax status. And this is what the case is arguing about, is that the tribal government says it should revert back to tax exempt status. When you look at, I talked about this earlier, so this is from Tracy. So we make properties in 2022 that have decreased the settlements by the numbers of properties taken in 23. Basically, we're making settlements on these properties at $279,000 a year. So far, we've spent $1.68 million on this. And it's at $280,000 a year. And so, and this is gonna go on and on. So this is gonna be a significant issue for the county, where I'm worried about paying the highway bills on the limited cash we have left. This is gonna go on for years. You're gonna have another $1 million that's gonna go out the door.
So properties that were always in tribal hands, does the county make settlement payments on those each year?
They're tax exempt.
So if it's always been in tribal hands, the county makes no settlement payments.
That's correct.
So the ones that left tribal hands, when taxes were collected, we're not collecting tax, but yet why do we have to make settlement payments?
So we've been in contact with the Department of Revenue. So there's a state law. So in a normal course of affair, a property that doesn't pay property taxes, after 3 years, Jen gives them notice, and then we take the property. And then we sell the property. Okay, so in this case, we are precluded by this court case from taking these pieces of property.
So we can't take them, but at some point when this is finally done, we're either gonna be able to collect taxes, or at the very least, we're not gonna have to make settlement payments. Is that correct?
So let me just finish this up, and your question should be answered here. The federal court case is being appealed to the 7th Circuit Court in Chicago. So the tribe has basically appealed it to the Chicago Circuit. If they rule in favor of the towns, there's consensus that they would appeal to the U.S. Supreme Court, since this is a federal issue. This is mostly happen sometime in 23 or 24. The county should be prepared to keep paying off these settlements for at least 3 years. If the towns win, the tribe could put the land into the U.S. trust land, which is tax-free. The next question on that issue would most likely end up in court, is that in order for the land to be put into trust, any back taxes need to be paid. That would most likely be challenged also. With the continued drain on the general fund, and being that these settlements are forced on us by the court, I would recommend the county replace the money being sent out by taking out maybe a 5 or 10 year bond for $2 million to build back your general fund per this court action. So to answer your question, Pat, is there are 2 possible outcomes. Well, there's actually more than that. There's a possible action where the towns win. The tribe puts it into, wants to put it in US trust lands. They still don't pay the tax, and that has to be gone before the courts. The towns win, the tribe pays the taxes, in which case we would be made whole. Or 2, the tribe wins, and they don't have to pay taxes, In which case, we would have probably a legal right to go back to the school district and the towns and recoup these millions of dollars we sent them. Which would be very challenging, which you towns are never gonna pay that money, I mean, they don't have that kind of money. In the short term, in our conversation, the reason I'm bringing this up, our attorney had a call with the chief counsel for the Department of Revenue yesterday, because this main issue is how can we stop the settlements? And without changing state law, we can't. So in the short term, over the next 3 or 4 years, you could look at changing state law to not force counties to make settlement payments in court cases which are being challenged by these ceded territory lands. But that's a long shot. You see how the legislators work on Madison. That's probably not, that's unrealistic. And I've been studying this issue for 4 or 5 months now. It's my opinion, and it's our attorney's opinion, that there is no way for us to stop the settlement payments until this either is finally decided by the circuit court or the Supreme Court, or it's put into trust lands. So we're at 1.6 right now. We're gonna drop it another 280 in August. And most likely, that's gonna keep on going for another 3 or 4 years. We're not gonna have the cash, okay? I'm just telling you, you're not gonna have the cash. And I think one of the issues is you may want to think about taking out a long-term bond to put money back into the general fund, because once your cash is gone, it's gonna be very challenging. As a government agency, you don't have an even inflow of money. You get money a couple times a year and then you spend it, and then you get money and then you spend it. The problem is going to be on those downtimes. And right now, the treasurer is worried about latter part of December, before taxes start coming in January. And she's like, that's gonna be a cash issue, because we're spending our cash now to pay for these highway funds, for these highway projects, which should have come out of the road funds. And I don't have a solution for you. I'm just bringing this up.
Just to make sure I'm clear, that 10-year bond can be placed on the debt levy. Is that correct?
Yes.
Okay.
Yeah.
Because if it couldn't, that would be, I'm not sure how that would help much, but.
Yeah, so basically, and our attorney's rationale is normally you can't take on debt levy and just put into your general fund. But in this case, what's happening is we are forced to make these payments by a court. Any court order can be put on the debt levy. And I've talked about this with you before, where we have $1.4 million of court ordered placements, adversarial consoles, psyche valves, guardian ad litems, all these other court orders. So you could replace money into the general fund. Also on that avenue, by saying we're gonna take all of our court orders and replace the money in the general fund that we had to use. And that's allowable by state law also. The issue is, you gotta get money back in your general fund one way or the other.
So related to the court orders and the debt levy and general levy in that relationship is, for the debt levy, if you pay it back, you have to incur that debt for at least 60 days. And then you can pay it off if you choose to. So one of the bigger questions that I think we should talk about is, if we chose to increase the debt levy to address some of the concerns, that means raising taxes, to some point that probably nobody's going to be happy with. But to replace some of that money, if that's a path that we want to go down, because it's something that you can do without a referendum. But at some point, you really need a referendum that passes to increase the general levy. And so I think those two things go hand in hand. One is getting through the immediate future and addressing some things that you bring up, and having a plan to, address it longer because of some of the things that you mentioned with the court orders. But you really have to have a plan in there to increase that general levy, but it's going to be hard to increase the general levy if at the same time your debt levy is such that people say, my God, tax increases have been too much already. Does that make sense? I think we got to think about both those issues in tandem and have a plan to get a referendum passed to keep some balance there. Because if it gets out of hand with the debt levy, let's say you raise taxes 6, 7, 8% a year for 3, 4, 5 years, that makes it very hard to get a referendum passed on the general levy.
Yeah.
And I think that's part of a financial plan and a strategy the board's gonna have to develop to address this in the next few years, so you can get something passed.
Yeah, so there's a couple avenues also which you can address, and the board will have to make some policy decisions in July or August. We're going through the lost revenue calculations for the ARPA money. The money that we basically will be able to, let's say, wash or clean from that can be used for any purpose. One of the ways that you could theoretically start putting a little bit of money back into your general fund is to take as much money as you can from that and spend it on, let's say we spend maybe $500,000 on outside non-mandated community contributions. So these are the Office on Aging, this is Extension Office, this is BART, this is the airport. These are things which the state government doesn't force us to do. If you did that, and take $500,000 or $600,000 a year to pay for those things, you wouldn't be spending general levy dollars on that. That general levy dollars could be left in the general fund, because you can't take the ARPA money, clean it through lost revenue, and then just leave it in the general fund. That is not allowed, nor is pension contributions beyond payroll. So, but that's going to interfere with some of the county board strategic planning, saying, I have other wishes for this. I want to take that money, I want to put it into the road fund. I'm going to take 2 million of that 3 and give it to the road department. I'm going to want to put in whatever, a treatment center. I'm going to want to do something else. So the county board is going to have all these other uses for it. Within Health and Human Services, this stuff is really geared towards Health and Human Services. I would advise the county, and I will advise the county board at your meeting, which is you should look at your internal self first before you look at any external outside things for this money, because you are in trouble and this money could help you. But we got to go through this calculation to figure out what kind of lost revenue we have, because right now the restrictions are very tight, and it's really just Health and Human Services, premium pay, sewer, water, broadband. That's about it. So it doesn't help. So those are all going to play into this thing as we go through the budget process. But in the long run, without the general fund having money, you're going to continue to struggle to make these settlement payments for years going on end, when it just goes out the door and you have no money coming in.
Realistically, we're talking 3 to 5 years, but more realistically, if this goes to a higher court in Chicago, I think it goes as far as 10, maybe even 10 years down the road.
Not necessarily. In talking with the attorney and the Department of Revenue, their thought is that sometime in 22 or early 23, the 7th Circuit would probably rule on this one way or the other. If they basically rule for the towns and the tribe wants to appeal, going to the Supreme Court, they normally would decide to hear a case or not hear a case within a year. And then they normally hear it the year after that. So that's maybe 3 years. Right now, there is the 2nd Circuit Court in the federal court system ruled kind of the worst of all possible worlds, that the tribe in the 2nd Circuit, I don't even know where that is, I think it's out east somewhere, doesn't have to pay taxes, but the county has to continue to make the settlement payments. Okay, so that's the worst of all possible outcomes from the county's perspective. So the question is, where does the 7th land? So if the 7th lands up on the opposite of that, the Supreme Court will hear the case because they don't like disagreements between circuit courts. So you're right. You're talking, so let's say the 7th does it in 22, 23. Let's say they appeal 23, 24. You might hear the case in 24 or 25. So the bottom line is you get at least another $750,000 to $1 million more that's going to go out the door. And that's cash that goes out the door that you have to have in the bank. And I don't know where you're going to get that money from.
And then we have no guarantees on getting it back either.
I think so. So explain to us what this $2 million, if we're to do a long-term $2 million bond here, that can only be utilized for this purpose. It can't, even though it's in a general account, we can't use it for other short.
So in my, the attorney's interpretation, if you basically take on debt levy for court orders, it can just be gone and put into the general fund. So consider the Health and Human Services. You are basically ordered by the court to make these placements, you know, Institute for Mental Disorders, you have high cost foster care. Right now, that money is just coming out of the general fund and you're paying it. We did $1.4 million last year, actually. Okay, so if you were to replace that money, it just goes back into the general fund. You can do what you want with it. Matt's example on the highway funds is not a court order. Matt's basically taking $520,000 and putting it on debt levy for road construction. He can't take $520 a year, in my interpretation, and only spend $250,000 and leave a couple $100,000 in the fund, because that's not a court order. But these other court orders, in our interpretation, is, and I frankly don't think the Department of Revenue is going to touch anything that we do, because they understand that we are so close on the cash. Whatever we do, they're probably just going to ignore it. So I am not worried from the legal consequences on this, frankly.
Yeah, you can't get blood out of a turnip.
No, yeah, you can't do that, but yeah, I mean, when I think about other counties that are our size that have 10, 12, $13 billion in the bank, that's our goal. But it's gonna take a long time to get there.
I guess the part I don't understand is, cost reimbursement. How much of that's a reimbursement and how far down the road does it take to get that reimbursed?
For what service?
Well, say court orders.
So like in Health and Human Services, Pete and Terry, Terry's on the line, you can even ask her the question. We basically expended about $2.2 million on these court ordered placements last year. We got back roughly $700,000 or $800,000, in which case hard counting tax dollars, property tax dollars that went out the door was 1.4 million. And that's what you could claim on your debt levy if you wanted to replace that money to put it back into the general fund. But you're gonna have to increase taxes by $1.4 million to get that money back into the general fund. Now, as Pat had alluded to, these big jumps are alarming to people. And maybe what you do is you say, we're gonna take out, you know, that's why I suggested, maybe you take out a 5-year bond or a 10-year bond. So instead of saying we're gonna increase your taxes $1 million this year, we're gonna increase your taxes $200,000 this year in order to make the bond payments, but we're gonna get the cash in the door right away. If you manage your finances well, hopefully you won't spend that money. And you'll just slowly build back up your general fund. So.
We need a cash guru. Make some recommendations to the board, because I'm lost.
Well, part of, what happens when you're in a tough financial spot is you're always dealing with what's immediately in front of you. It's just how it is. You're trying to get through the day and the next day and whatever. And that means you're doing less long-term planning. So, all of these things, like, saying to Matt with the highway there, whatever X is in a steady increase, you can start planning for stuff. And then you're not dealing with the immediate all the time. And so, yeah, we can do some borrowing, we can put some stuff on the debt levy, and then whatever that is, if it's sufficient to do what we need to do, and then keep it steady from there, with whatever reasonable increase we have. But, when you look at what happens is you get these, rather large variations with stuff. And, so when I look at the taxes, I always go back, 10 years on my tax bills to say, okay, I'm not going to look at just one. I'm going to look at the average. I'm going to look at that in relation to inflation and other things. But I'm also going to look at the other tax entities and see, how they have been doing with that. People react to those large increases. I think that's natural. And what they react less to is the ones that are smaller or maybe even go down. But when you get people ticked off with big increases, you can get some change in elected bodies. One of the concerns I have is, in any elected body, is if you get a bunch of people on there that say, by God, I don't give a damn, I'm just gonna cut, that's why I'm here, and that's what my friends ran for too, is then you do what I would describe as really inefficient things, because you cut things to the bare bones and stuff. And you lose things that you really, the community doesn't want to lose. And anytime you lose things, it's always harder to get it back to where you were. And so I think of that as an inefficiency in government services, that being steady and thoughtful and adapting and adjusting as the world changes, to me, is the most efficient path and the one that tends to have the most public support and least angst. And most people like that steady thing. And as we look at finances, between the debt levy and the referendum on the general levy again, you'd like to get to that steady state. And it's hard when we're dealing with the immediate all the time.
So Mike,
Yeah.
when my wife and I were first married, we got married in college, you know, we had these envelopes that we paid bills with. We set aside money for the electric bill, we set aside money for rent, we set aside money for food and the car payment. You know, and yeah, if something changed, yeah, maybe we may borrow from one envelope and put it in the next, but in the end, when all the envelopes are empty, you were broke. And I think that's partly where you're at, is you've been basically taking money from all these little envelopes and just spending it on the things that you have, because you just, you know, you were forced to do it, you know. And part of it is these settlements, part of it was that this long-term 15-year decline in healthcare. Part of it is, I don't know where, I don't have time to look into it.
So we're being, correct me if I'm wrong, or, excuse me, we're being pushed in the corner to it. We're gonna have to borrow a couple, $2-3 million long-term, just to remain solvent. Pretty
So,
much.
yeah, and so this is my idea. I'm gonna run it by the fiscal consultants, because those guys are much more astute in business acumen than I have. And I'm gonna run it by them to say, is this a crazy idea? But one of their tasks, the Department of Revenue said specifically, they want to see a detailed cash flow analysis, because I've always said that you're gonna run out of money in 2022. I still think I'm right, but we need people that have CPAs to tell us that, versus me just seated the pants and on my back of a napkin. But that's what the Department of Revenue is worried about, because there isn't any remedy in the state if a county can't pay its bills. There's nothing that the state has contemplated. There's no law, there's no legislative path to figure out what happens. And so, yeah, I think you're gonna end up there. I think that's gonna be a choice you're gonna have to make this fall. But, you know, hopefully the financial consultants will guide you in that decision.
The other thing with all of this is our bond rating isn't going to be what it used to be, given our finances. And then when interest rates go back up at some point, it's going to be harder too. So those are things those consultants are going to have to consider as part of the overall picture.
Right now, you haven't been borrowing on bonds, you're just borrowing from the local bank. Your overall debt structure is not very high, actually.
Yeah.
Your overall debt for the county right now, long-term debt, is somewhere around $2.3 million. You basically have the line of credit, which I cleaned up and put into an 8-year note. That's like at 1.8. You have a couple of buildings for health and human services. There may be, I don't know, $500,000 there. Couple of little small trucks and cars and stuff like that, like the sheriff's department has used in the past for some reason. But you don't have a ton of debt. Your borrowing capacity as an agency is $65 million. You could go out and borrow $65 million on the open market with a bond, and people would write that because that's what the state would allow you to do. Now, that's not going to be prudent to borrow $65 million, but you're never going to bump up against your maximum state allowable thing. The problem on the bonding level, we don't have a bond rating because we haven't had bonds for 25 years. And because I had to investigate this for a couple of federal issues, and we don't currently have it.
but all things considered, the worst our finances, if we do need to borrow and get a bond rating, the lower it's gonna be.
That would be exactly correct. Yes, I don't know why, I mean, I don't know what they would do if you went to Bill for marketing, but,
They'd laugh.
I don't know, yeah, it's hard to say. We may have to go to Vino down the street, you know, and, you know, he's gonna take your kneecaps off, Pat, if you don't pay.
Well, and to be perfectly honest, it's not that I mean, now we're pushed in a corner and mostly we've done it ourselves as a board. Because if we'd have built in those small incremental increases as Pat has talked about, you know, I get that we have things that are not being reimbursed by the state and unfunded mandates, but we knew that, I knew that in the 90s. So county boards had to know that too. So now we're just getting, I mean, the rob Peter to pay Paul thing is not working anymore. Because you know what? Those envelopes are empty, like Clark said. So it falls squarely on us. So yeah, we're probably gonna have to do some things that are a little uncomfortable and just try to let people know we're doing the best that we can with this situation.
So are we done with this update for town center?
I don't have any other, I mean, this is just this is just for your general information about the Sanborn case. Do you find it useful to hear about this? I think I should do the whole county board?
I think
Yeah.
everybody needs to
Do
know.
you have any suggestions on how I should present it? How I can improve on this, because I understand it, but I've been living this thing. Do you guys, I mean, is there anyone, I mean, if you guys understood what I said, I can just replicate this, but if you think I can improve on the situation, let me know.
Yeah, you're telling us that we have to pay out this money no matter what every year.
Yep.
So looking at our budget, we're in the hole.
Yeah, just take out that one word you have in there that you skipped when you were reading that you don't need.
Yes.
Yeah, it's short enough and clear enough. And then some of the follow-up discussion I think was helpful too. So maybe just a little bit of, you know, what the answer that you gave Mike. Just those possibilities, maybe as a bullet or a list as far as how long does the board have to deal with this?
I think one of the things Clark would have to present to the board would be to explain how these payments are being made and why they're being made. Very difficult to understand why we're paying for something we don't have. And you're never gonna get back. Never gonna get it back.
I actually don't ever see you getting the money back. So let's say you get to take the property by the courts. You're never gonna get the money out of it. I don't think anybody's gonna buy that property for the money that you dumped into it.
Yeah.
I mean, you might be able to sell the property, but I think your rates are gonna be fairly low. I don't think you're gonna get a ton of people that are gonna wanna buy this property. Most of this land is former logging land. 95% of it is owned by the tribal government themselves. And it was former companies that owned this stuff, and they basically sold it to the tribe. So it's not like it's developing, it's not like it's housing, it's, you know.
Not only, I think, would this be a good topic for the board, but I think for the local newspaper, you know, all three of them in the county, just a story on the basics of this and where this is leading and the possibilities. Because when people say, why am I paying these taxes? Sometimes there's issues like this that we, you know, don't think about. And if people understand how much is gone and how much might more go and why, it helps them understand the burden on the county with some things.
I never knew that we were paying out all this money.
Yeah.
And why. And yeah, we're gonna be in the hole. That's all there is to it.
Yeah,
And
and
back in the day, the town center just made a resolution, passed a resolution, subject to what happened up in Kawani Bay. No, it was not apples and apples. It was two different things, and that's why we're at.
yeah, I've been asked by members of the public 3-4 times in the last couple of months on this topic.
Some people are aware of it.
Yeah, but I think a story
I know
in the
people affected
newspaper.
by it,
Yeah,
you know.
All right, I'll try to produce something for Rick too then.
And our other two papers.
Yes.
Verbal update.
I'm done talking. I'm talking enough for today.
Next meeting date?
Next meeting date, yeah.
I got down, about, July 13th. And that's the day after my birthday on the 12th. I'm turning 60.
Are you fishing for cake?
I'm thinking, I'll bring some cupcakes in from Super One. How about that?
They don't have cupcakes.
July 13th.
July 13th.
I'll make you a
July
cupcake with a
13th.
whole bunch of candles in it.
And then so what will happen then is we'll set the August dates, and I think last year you met in August, and I think you met twice in September. You know, when I think about the budget timeline, and we went through that, I didn't put this on the agenda, but we went through the budget timeline. And, you know, last year we did like we had the county board weigh in the budget. And then it went back to finance again in October to make sure that there's any feedback. So I think we'll probably meet once in August, maybe twice in September to work through the budget so that you can get it presented to the county board the first part of October. So the county board gets to weigh in. In the past, the county board first saw the budget at the public hearing in November. And there was an opportunity to do anything. This way, the county board can give you feedback as a finance committee. In October, you can change it and then address that and put it back up for public hearing on November 9th.
Is July 13th going to allow us to get the survey data, which I think ends July 7th, if I remember?
I talked to Alyssa and Mary yesterday. I doubt we'll have that information by then. Alyssa thought it would take a little bit longer than that, maybe the end of July. We did have 170 responses so far as of yesterday, which is very good. I mean, that's a lot for this little thing.
I'm handing that thing out like candy.
We appreciate that. And quit filling it out multiple times, Laura. I'm watching your IP address.
There we go. I know how to block that too.
So you got July 13th. Were you going to ask for an August date?
Let me see here, let's get this down here so we know what's going on. So normally you'd meet probably around on the 10th of August. That's also a possible date for county board. I don't have an August date. I think I gotta figure out when because county board takes precedent. But we'll know more in the next few weeks.
Okay.
13th of July.
Clark, do you have any idea when we'll get some feedback from the financial consulting people?
They're about half done with it. We're thinking they'll have something in July also. Their goal is not to stretch this out. We would like to, I've told them we would want to incorporate some of their findings into our budget process. The way we budget is not surprisingly a little screwy to them. You know, so they would like to have some suggestions in that also with, I have that nice little spreadsheet I put together you saw last time. And they're like, well, we have a different idea. And I'm like, well, I can understand this. So I don't know, I guess we'll see what they're gonna have to say.
Motion adjourned. Motion adjourned.
I won't make a motion to adjourn. I'll second.
We have a motion, a second to adjourn. All those in favor say aye.
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 Opposed, motion carried. Thank you.